Welcome back to Plan Life Right. I'm Kevin Ross.
And I'm Matt Floyd. Kevin, I want to start today with a question I actually got wrong for years.
All right, go ahead, Matt.
Is Medicare free?
No. Medicare is not free, and for a growing number of retirees, it's not even close to being free. The standard Part B premium in 2026 is $202.90 a month, and that is per person. The average Part D drug plan at a supplement to cover what Medicare doesn't, and a married couple is easily looking at $600 to $800 a month just to have coverage.
Before a single claim is even filed.
Yep, before a single claim is filed. And then for a specific group of retirees, there's a surcharge layered on top of all of that. And that surcharge with a 4-letter name that most people have never heard till that bill arrives.
IRMAA.
The income-related monthly adjustment amount. And it can add hundreds of dollars a month to your Medicare cost. It expires based on income you earned 2 years ago. Why not? I mean, let's make it complicated.
Yeah.
Exactly. And for some retirees, one Roth conversion or one home sale, one inheritance triggers it without any warning at all.
So they made a reasonable financial decision in 1 year and got a Medicare bill for it 2 years down the road.
It's exactly what happens, man. Today we explain how it works, who gets hit, what you can still do if the danger window is open right now. Okay, so let's build a real number, Matt, because most people arrive at Medicare thinking they've been paying into it their whole careers, so it should be free or at least close to it.
And there's truth to that. You do pay Medicare taxes your entire working life.
You pay for Part A, hospital coverage through payroll taxes. That part is free for most people when they retire. But Part B, which is your doctors, your outpatient, your preventive care, that has a monthly premium. Of course, that's not covered.
Right.
So in 2026, that's $202.90 per month per person.
Which means a couple pays over $400 a month just for the base Part B premium before anything else.
Yeah. So then you got to add Part D. That's your prescription drug coverage. The average standalone plan is $34.50 a month. Most people add a Medicare supplement as well, called like a MedGap policy to cover the gaps, deductibles, copays, the 20% that Medicare doesn't pay. So a solid supplement for a 65-year-old runs another $150 to $250 a month, depending on the plan and where you live.
So we're looking at what, $400 a month per person conservatively.
Yeah, per person conservatively, a married couple is going to be anywhere from like $700 to $900 a month just for coverage.
That's the coverage that keeps you out of the Part A, the part that they pick up.
God forbid if you filed at 62. That was last week's show. All right, so before any out-of-pocket costs, before dental, before vision, before hearing, none of which does original Medicare cover.
So that $315,000 number that I've heard cited, the estimate of what an average retired couple spends on healthcare in retirement, that number is starting to make a lot of sense now.
Yeah, that figure comes from Fidelity's research, and it's been consistent for years. And it, guess what, does not include long-term care.
Yep.
It's purely premiums, out-of-pocket costs, and the expenses that Medicare doesn't touch. Healthcare is the second largest expense in retirement for most households. And it grows faster than inflation. Okay, so let's talk about the trap that's inside the cost. IRMAA. That's the income related monthly adjustment amount. And here's the simple version. If your income exceeds a certain threshold, the government charges you more for Medicare every month automatically.
How much more?
In 2026, the first tier adds $81.20 a month to your Part B premium, plus $14.50 a month on top of your Part D premium. So now that's nearly $1,150 a year extra for a single person just at tier 1. At the top tier, the Part B surcharge alone is $487 a month per person.
So a married couple at the top tier could be paying almost $1,000 a month just in IRMAA surcharges on top of their standard premium.
Yeah, on top of the standard premium, that's correct. And most people hitting the top tier are not multimillionaires. They're successful retirees who had a good year, a Roth conversion, a business sale, a required minimum distribution, and they crossed a line that they didn't even know existed.
So what are the income thresholds where this kicks in?
Okay, in 2026, for a single filer, IRMAA starts at $109,000 in modified adjusted gross income. For married couples filing jointly, that's $218,000.
Those numbers sound high, but in retirement with Social Security, a pension, RMDs, maybe a Roth conversion here or there, a lot of people get there without even realizing it.
Yeah, that's exactly the problem.
You got somebody who's like, "Oh man, I made 6 figures in retirement. This is great."
And all of a sudden,
wait 2
money's
years.
Retirees do not always think about all of their income sources stacking together, and that's what gets missed most of the time. Their pension counts, their Social Security counts, at least up to 85% of it, because the government's figured out how to tax our Social Security that we paid into. Their required minimum distributions count as well, their RMDs. If they do a Roth conversion, which I do highly recommend in most cases, to reduce future taxes, that conversion still counts if they've waited too long.
Yep.
It all adds up. And then 1 year, they cross the threshold. Okay, so here's the part that makes IRMAA genuinely dangerous. And that's the part almost no one ever gets explained to clearly.
That's that 2-year look back.
Yep. Your 2026 Medicare premium is based on your income from 2024. Not what you earn today, not what you earned last year. What you reported on your 2024 federal tax return.
So a decision you made in 2024, a Roth conversion, selling a rental property, taking a larger distribution, that shows up as higher Medicare bills in 2026, 2 years later.
Yeah, 2 years later, after that income is spent and after that tax on it's been paid. There is no refund. There is no appeal based on regret. The only appeal that works is a documented life-changing event. So retirement, divorce, death of a spouse.
So what if someone retired in 2025 and their income dropped significantly, but the 2024 still shows high earnings from when they were working?
All right, so that's one of the most common situations that I see. They retire in 2025, the income drops dramatically,
Right.
but Medicare in 2026 looks at 2024, their last full working year. And it changes them in surcharge based on a salary that they no longer earn. There is a form called the SSA 44, and you can file it to appeal based on retirement as a life-changing event, which I do recommend. Most people, guess what? I've never heard of that form.
And the government is not going to call you and tell you it exists. Like, hey, I saw we charge you a lot for
Hey,
IRMAA.
Matt.
Did you fill out that form?
Yeah, it's SSA 44. And they don't do that. The government is never going to call you with that helpful information.
No.
The 2-year delay means you have to think about Medicare premiums before you are actually even on Medicare. The income decisions that you make at 62 and at 63 set the Medicare bill that you're going to receive at 65.
Mm-hmm.
Most people find that out the hard way. Look, there's one more mechanic I want to make sure that every listener understands, and this is important because it's the part that makes IRMAA really feel unfair, even when it's technically working as it is designed.
Yeah, it's that cliff.
IRMAA operates on an income brackets with hard edges, okay? If you earn $1 over the threshold, guess what? You jump to the next tier. The full jump, not a gradual increase.
Yeah, $1 is all it takes.
$1. So $1 of that income over the 109,000 single filer threshold, and the surcharge kicks in on the entire Part B premium. $1 over the next tier, and it jumps again.
So if someone could do a $50,000 Roth conversion, accidentally push $1,000 over their threshold and pay an extra $1,150 in Medicare premiums the following year and the one after that, depending on whenever it clears.
The exact scenario happens thousands of times a year. The Roth conversion was the right long-term move, but nobody modeled the Medicare interaction before they pulled the trigger.
So the lesson is not do Roth conversions. The lesson is run the Medicare impact before you decide how much to convert.
Yep. Look, you got to run the full picture. How much does the conversion add to your income? Where does that land relative to the IRMAA thresholds? And is there a way to convert just enough to stay under the cliff, or just enough that crossing it is still worth it? Sometimes crossing that threshold really makes sense still.
Right.
The mistake is not knowing where the edges are before you make that step. So here's the practical side. 3 things every pre-retiree should have on their radar before they turn 65.
Starting with the 2 years before Medicare.
That's the critical window. The income you report on your tax return at 63 and 64 determines your Part B premium at 65 and 66. If you can manage your income in those 2 years, keep the MAGI below the threshold, you start Medicare at the standard premium. That means being strategic about Roth conversions, capital gains, and distributions in those years. Second, if you retire and your income drops, file SSA 44 immediately.
Yeah.
Do not wait for the bill.
Whoever you're working with retirement with right now, ask them about SSA 44. And if they give you that blank stare back, leave their office. Or tell them to call us.
Yeah. Yeah. So don't wait for the bill. Don't assume it will be corrected automatically, because it won't. That form exists specifically for people whose income dropped due to retirement, divorce, or a loss of a spouse. Then you file it. You get the corrected premium.
And it takes time to process. So, I mean, the sooner you file, the sooner that correction is going to apply.
Yeah, fill it the day you retire if you have to. That way you're ahead of the game. And then third, I want you to model IRMAA into every income decision that you make after 60. Not just the tax impact, called the Medicare impact. They're not the same calculation, and ignoring one while optimizing for the other is how smart people end up with a bill they did not see coming.
That's the difference between tax planning and retirement income planning. One is a subset of the other.
Yeah, tax planning is a tool inside a retirement income plan. It's not the plan. Here's what I want every listener to do this week. Go to planliferight.com. Take the retirement income scorecard. It's free. 7 minutes max. One of the questions it asks is whether healthcare costs are accounted for in your income plan. Not as an afterthought, as a line item sized correctly, growing at healthcare inflation rates with Medicare premium built in.
Because if the scorecard comes back and healthcare is not accounted for, that gap alone could be the difference between a plan that works and one that runs out.
PlanLifeRight.com. It's free. Before your next financial decision, do it.
Kevin, a question for the advisors. When you're working with a client on a Roth conversion strategy, is IRMAA typically part of that conversation?
Well, it should be, but not always. And when it's not, the advisor is optimizing for one tax variable while ignoring another. That's a fact. The client ends up with a technically sound conversion and a Medicare bill that really no one's even modeled.
And that's a trust problem.
Yeah, it is a trust problem because the client feels blindsided, not by the market, not by circumstances, by their advisor's blind spot.
Yeah, you don't want to be that advisor whose every client in year 2 gets sucker punched.
Yeah, exactly.
Not going to end up with a lot of referrals
that gets talked about. AdvisorRescue.net. Schedule a strategy call with one of our experts. We walk advisors through the integrated income planning approach where tax strategy, Medicare exposure, and Social Security timing are modeled all together, not in separate silos.
The advisors who do it that way are not just managing assets, they are managing the full retirement picture. And that's what earns referrals.
AdvisorRescue.net. Strategy call is free. The blind spot, guess what? It's not.
It's definitely not.
Okay, we're 2 episodes in. Social Security timing, Medicare cost, both on the income and expense side of the equation. Next week, we move to the account that most Americans believe is their retirement plan.
The old 401k.
And specifically, the $1 million balance that looks like security and turns out to be something very different.
Because a balance on a statement and a guaranteed monthly income are not the same thing.
They are not the same thing, Matt. We have a couple, 1.2 million saved, both sleeping terribly. We're going to tell you exactly why, exactly what they did about it. Next week on Plan Life Right, the $1 million mistake nobody sees coming. Life happens fast.
Make sure your income is ready for it.
I'm Kevin Ross.
And I'm Matt Floyd.
This is Plan Life Right.